Ladies and gentlemen, good day and welcome to Q4 and FY22 conference call of Eris Lifesciences. We have with us on the call today Mr. Amit Bakshi, Chairman and Managing Director, and Mr. V. Krishnakumar, Chief Operating Officer and Executive Director. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. V. Krishnakumar, Chief Operating Officer and Executive Director of the company. Thank you and over to you, sir.
Thank you. Good afternoon and welcome to our fourth quarter conference call. I am Krishna Kumar and I am happy to connect with you today. At the outset, I am delighted to inform you that Eris has entered the elite club of Indian pharma companies to have crossed 400 crore rupees of profit after tax in just 15 years from inception. There are a less than handful of pharma companies in this category. We have delivered an EPS growth of 14% in this financial year on the back of a 21% EPS growth which we delivered in the last financial year. This represents a compounded annual growth rate of 18% over the last 2 financial years. Now let me take you through the financial and business highlights for the quarter and the year. As per AWACS, the Indian pharma market grew by nearly 4% in quarter 4 of 22. Acute therapies grew at 5.5% as COVID and other infections started waning. Chronic and subchronic therapies grew by 2.6%, which is the third quarter in a row of subdued growth, compared to the long-term average quarterly growth rate of 10 to 11%, which the chronic segment has seen for the longest period of time. In comparison, I am happy to share that Eris grew at 9.2% in quarter 4 of this year. Our core cardiometabolic franchise, which is 60% of our business, grew at 14.1% in Q4 compared to a market growth of 2.8%. VMN, which is our third largest therapy, has grown at 8.6% in FY22 versus the market growth of 12.2%. CNS, which is 8% of our business, grew 33% for the year compared to a market growth of 9%, so nearly 4 times of the market. And women's health, which is again a very fast-growing segment for us, grew at 24-25% for the year compared to a market growth of 15%. When we compare from the pre-COVID base, Eris has grown at 3x of the Indian pharma market. That is, Eris has grown at a CAGR of 9% compared to the pharma market CAGR of 3% excluding COVID medication. On this basis, Eris continues to feature among the top 10 fastest growing pharma companies in the IPM when you take it from pre-COVID levels. At the start of the year, we had guided for 3 key product launches and 10 total new launches for FY22. In line with our guidance, we have launched 3 key products: Exulin, which is our brand of human insulin; Drolute, which is our brand in the fast-growing dydrogesterone market; and Linares, which is our brand of linagliptin, a commercially attractive opportunity in the DPP-4 inhibitor segment in oral diabetes. All these 3 key launches happened in quarter 4 of FY22. In addition, our power brands in diabetes such as Glimisave, Zomelis and Gluxit continue to enjoy dominant market positions in their respective segments. On the back of our strong position in the oral anti-diabetes market, this year marked our entry into insulin through a joint venture with MJ Biopharm, in which Eris holds 70% equity stake. Through the formation of this joint venture, we bridge an important gap in our diabetes care portfolio and are well positioned to leverage the market opportunity in insulins, analogs and GLP-1 inhibitors. By way of detailed financials, our consolidated operating revenue for quarter 4 stood at rupees 306 crore, which represents a 10% growth over quarter 4 of last year. The consolidated EBITDA for this quarter was rupees 97 crores, which is a growth of 2.5% over Q4 of last year. As I mentioned, Q4 of this year has been a very heavy investment quarter for the company in terms of strategic new product launches like Drolute, Exulin, and Linares, as well as the launch of a dedicated insulin division with a field force of 200 personnel, the impact of all of which is reflected in the Q4 EBITDA margin. Consolidated profit after tax for Q4 stood at 80 crores, which represents a growth of nearly 17% over Q4 of last year. Consolidated revenue for the year stands at rupees 1,347 crores and has grown by 11% over last year. Consolidated EBITDA for the year is rupees 485 crores, which represents an EBITDA margin of 36% and an EBITDA growth of 12.6% over last year. Consolidated profit after tax for the year is rupees 406 crores, which represents a year-on-year growth of 14.3% over last year. Our standalone YPM grew to rupees 5 lakhs in this financial year, FY22, up from rupees 4.5 lakhs in FY21. Our business model continues to be cash accretive with a consolidated operating cash flow of rupees 378 crores in FY22, which represents 78% of EBITDA. As guided by our dividend policy, in FY22 we have declared and paid a dividend of rupees 6.01 per share, which implies a payout ratio of 20% of consolidated net profits. FY23 represents the start of an exciting period in the diabetes space in terms of molecules losing exclusivity and hence a deluge of new product launches. We expect to launch more than 15 new products in this financial year, including 5 to 6 significant new products. Moving on, in line with our inorganic growth strategy which we have articulated to you, Eris has today announced the acquisition of 100% equity stake in Oaknet Healthcare, a dermatology-focused domestic formulations company. As Oaknet becomes part of the Eris group, it brings with it a well-established portfolio of brands in dermatology and women's health, both of which are areas of strategic interest for us. Oaknet had a revenue base of rupees 195 crores for the year ended March 31, 2022. The Eris specialty franchise will get a significant impetus with the acquisition of Oaknet. Along with Oaknet, Eris is now present in 87% of the chronic market, which is worth rupees 55,000 crores, with a leading presence in the major chronic therapies in the market, namely cardiology, oral diabetes care, insulin, neurology, CNS, and dermatology. Oaknet has near 100% coverage of approximately 11,000 dermatologists across India with a 60% penetration. Oaknet derives 43% of its total prescriptions in dermatology from dermatologists compared to 38% for the market, which suggests that Oaknet has a very strong specialty franchise. In addition, Oaknet is very strong in medical dermatology, which is curative, and in a tropical country like India, will always remain the bedrock of the dermatology business. This acquisition also gives us an opportunity to scale up the cosmetology franchise, which is largely driven by dermatologists. The deal brings marquee brands like Cosvate and Cosmelite into the Eris portfolio. 4 out of the top 5 derma brands of Oaknet are ranked within the top 5 in their respective segments. We've already seen that Eris is in a high growth phase in the women's health category with a 24% year-on-year growth in FY22. The addition of Oaknet will give us the opportunity to cross-sell the Oaknet portfolio as well. The acquisition will be completed by way of a share purchase agreement, as a result of which Oaknet will become a wholly owned subsidiary of Eris and will be renamed as Eris Oaknet Healthcare Ltd. The total consideration payable for the stake is rupees 650 crores, out of which rupees 300 crores will be sourced from internal accruals and rupees 350 crores will be financed by borrowings. We expect the transaction to achieve financial closure by the end of May 2022. We have created significant value from our acquisitions of the Strides domestic business and Zomelis brand through multiple levers, including brand growth, launch of line extensions, expansion of field force productivity, and significant cost reduction. As we integrate Oaknet operations, we expect significant value creation levers to come into play through new product launches in medical dermatology as well as cosmetology, expansion of field force productivity, and other operating efficiencies. Our 2-year outlook on this business is a revenue of rupees 250 crores along with an EBITDA of rupees 50 crores, which represents a 20% EBITDA margin. This is our target for financial year 24. We expect this acquisition to strengthen our foundation in the domestic market along with therapeutic diversification, and we are confident that the deal will create value for our shareholders in the long term. Our growth in FY22 as well as over the next 3 years will be led by growth in our power brands portfolio, leveraging patent expiration opportunities, and through scaling up our insulin and Oaknet businesses. We are also exploring some interesting in-licensing opportunities on which we will keep you updated. In FY23, we are targeting an organic revenue growth of 15% and a combined revenue growth of 30%, including Oaknet. We are looking at an organic EBITDA growth excluding Oaknet of 15% and an organic EPS growth excluding Oaknet of 11 to 12% in FY23. A higher magnitude of depreciation will come to play in FY23 on account of the commissioning of our new manufacturing facility later this year. FY23 will also be a heavy year in terms of investments being made, including the insulin business, the scale-up of Oaknet, field force expansion in our cardiometabolic business, landmark new product launches, the commissioning of our new manufacturing facility, and the implementation of SAP S/4HANA. These were the highlights of the quarter. We are now happy to open up for questions.
Thank you very much. Ladies and gentlemen, we now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Amay Chalke from Haitong Securities. Please go ahead.
Yeah. Thank you for taking the question. Yeah. So, first question on the Oaknet acquisition. Basically, this is around 190 crore revenue portfolio. However, there is only one large brand which I can observe, which is around 40 to 45 crore in revenue size, which is also not very sizable, as in where we could really call it as a large brand. This basically also reflects in the profitability of the company, which is substantially lower than our Eris profitability level at this point of time. So I really wanted to understand the rationale behind this acquisition with respect to these points, and also if you can talk about the clobetasol market where the Oaknet has large franchise basically, and why this particular molecule and not any other molecule in this therapy. Yeah.
Yeah. So I'll take it one by one. So look, if you go through the financials, you'll find that the gross margins are in excess of 73%, which we believe can be expanded this year itself and can over a period of time reach 76 to 78%. Why I say that, one of the levers there is that there is a lot of price increment headroom which is available in these leading brands. So when you have a 73 to 75% of gross margin, it is the line items in between which basically affects the EBITDA. And generally, the most important factor there becomes productivity. So the low EBITDA is on account of low productivity rather than low gross margins. So we have our idea around productivity. We want to increase this productivity to a reasonable level. We look at a we can see a 5 lakh kind of productivity over a period of time, but that is something which is possible. So as soon as the business starts attaining productivity, the EBITDA margins can swell. And if you remember, we took strides when there was almost no EBITDA. And now we can assure you that Strides EBITDA is in line with the company's EBITDA. That's number one. Number two, you are right about the clobetasol market. Look, what we tend to forget a little bit is that India is a topical country. Therefore, the basic infection, so the bedrock is dermatology, curative dermatology, which is skin infection, atopic dermatitis, so on and so forth, psoriasis. Now, while being the old product, these products getting out of use is very, very difficult, in my opinion. And what it also does is, what cosmetology doesn't offer is wide range of prescriber base. That is a high price point products. But if you go through the products, there are very few prescribers. Here, as KK told you in the opening call, we have almost 60% penetration in the overall population of dermatologists. That is a good point to start. So, is clobetasol something which we can look at 15% year-on-year growth? The answer is no. The good thing is we can look at 7 to 9% of price rise for the next 5 years. That's the kind of headroom the prices do have. But from an organic unit perspective, no. But then it gives you a very solid bedrock in entering dermatology for other products, the newer dermatology products, and also cosmetologies to be built upon them.
Sure. Thank you for asking that. And the second question is related to insulin. I guess you have already garnered crore plus sales in the first quarter itself. So wanted to know how has been the reception and if any few learnings from this launch, and also the outlook if you can provide on this insulin portfolio.
So I think we should be closing into 20 crores in the first full year of launch, which to my mind would be a record of sorts. We just looked into numbers. We couldn't find anybody in the first year getting there. So I think that would be a record in sorts, and that is playing out very well. As you must be informed that there has been a 10% price hike which has been given to DPCO product. So once the new batches come in, we will be incorporating that price hike also. That price hike will significantly improve the gross margins also. We will continue to launch newer products in human insulin range. As of now, we are launching a disposable pen in the month of May. So that will be our entry to disposable pen market, around 200 to 150 crores, decent market. So we are happy with insulin. The fun and the scale up will happen when the newer insulin will come. But first year, we think that we will be able to garner close to 20 crore rupees of sale on around 140 people division.
Just second question related to insulin. What is our offering exactly when we go to the doctor? Is it the pricing or anything else which is apart from the product in terms of any device or anything which you try to sell it basically when you go to the doctor?
So it's a little technical, but since you've asked, I'll be happy to answer you. Look, our game in this market is using insulin and CGM together. So you get a little bit of a pump effect. If you use the CGM while initiating the patients and you monitor the glucose and then adjust your insulin levels. So typically we have seen global data is that there needs to be 10 incremental dosage of insulin to get to the control level. But without having a running selfie like a CGM, there has been a hitch in the physician mind to get right there for the fear of hypoglycemia. So our number one offering is usage of insulin with CGM and try to make it, comparable to a insulin pump. So that is where the whole game is. So we are initiating a lot of insulin pumps, CGMs with the usage of insulin. So combining technology with insulin is the way forward globally. And because of all these patient care initiatives we had an advantage of going there. we are working and talking to people to get in more technology on insulin. Insulin, to our mind, will sell more with better technologies than the product itself.
Sure. Thank you for taking my question. I will join back.
Sure.
Thank you. We'll take a next question from the line of Tarang from Old Bridge Capital. Please go ahead.
Hi, good evening. Couple of questions from my side. One, how many additional MRs do you think you'll be onboarding in your Dermat and Cosmeto franchise? Given the GCs on the business, the forecast for 24 seems a little conservative on the EBITDA. That's number one. Number two, KK guided a 15% growth in revenue and consequently 15% growth in profitability, operating profits for FY23. One would have presumed profitability to grow much higher given the GCs and given the price increase that the franchise can take. So what is driving significantly higher costs in FY23 over FY22 above the EBITDA levels? Thanks.
%, growth guidance on top line and EBITDA organically, that is being provided for the Eris business excluding Oaknet. Right? That's the first clarification. And we have provided an EPS growth guidance of 11 to 12% for the same business, which is the current Eris excluding Oaknet. And I will answer your question on EBITDA growth being in line with top line growth and why is EBITDA growth not faster. I would like to reiterate that FY23 is a year of monumental investments for the company. I mean, we have not seen so many categories of investments coming together, in 1 year, in a long time. So, we have guided to 15 new products for the launch, 15 new product launches for the year, including 5 or 6 major launches. So this has its own impact, on marketing and promotion. Then we have the insulin business, which is scaling up, right? Because we have created a 200 strong field force only in February, March timeframe. So the full cost of that 200 member division is going to come for the first time in this financial year. And that's a significant number. So that will be the second item. Thirdly, we have the new manufacturing plant at Gujarat that is going to get commissioned in September-October timeframe. So the operating costs of that manufacturing facility are going to be sitting in our accounts for at least half of the year. And last but not the least, we are taking up SAP S/4HANA implementation. It's not a major amount, but it is still a finite expense item. So despite all of these costs coming into the P&L for the first time in this financial year, we are still confident of delivering EBITDA growth in line with top line growth. And that is something, that is going to happen because a lot of the new products that we launched in the last 2-3 years, they are scaling up very admirably. For example, Zomelis will be a 100 crore franchise this year, right? And, Gluxit should be a 50 crore franchise this year. So because of the scale up of products and consistent growth, the YPM will improve, right? So whatever, acceleration in EBITDA is brought about by the YPM improve will be partly nullified by the investments during the year, which is why we are guiding to 15% EBITDA growth on a top line of 15%. As far as Oaknet is concerned, we have not provided any guidance for FY23 yet. We have shared numbers of, at present in the financial year 22, Oaknet had an EBITDA margin of 10%. And that does not worry us too much. Because as Amit said, Oaknet has a gross profit margin of nearly 75%, which is fantastic because our consolidated gross profit margin is 81%. So of the plethora of assets that one sees in the market, which come up for acquisition, 75% gross margin is really a fantastic number. So we will bring operational efficiencies on bear. We will bring, YPM productivity, field force productivity initiatives. We will bring in new product launches. And we are confident that we can take this from a 10% EBITDA margin business to a 20% EBITDA margin business in 2 years. So our FY24 guidance is 20% EBITDA because our starting point is 10%. As far as the numbers for FY23 are concerned from Oaknet, as you might have known, we have still not closed the deal. It will take us some time to do that. So by the time we come back to you next quarter, we will have a very clear view on what FY23 numbers will be for Oaknet, and we will give you an update at that time.
Correct. Just to follow up, I mean, I understand this glide path from 10 to 20%, but I was just wondering that, just wanted to get a sense on the incremental number of MRs that are likely to be added to achieve the revenue and operating profitability threshold that, you're guiding for.
So currently the business has 650 MRs.
Okay.
And we are not planning to add any.
Okay. Thank you.
Thank you. Before we take our next question, we would like to remind participants to ask a question. You may enter star and 1. We'll take a next question from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Hi, sir. Just checking. You guys can hear me?
Yes, Anubhav.
One clarity on this gross margin 75%, EBITDA margin 10%. Other than productivity, is there any line item which is really depressing it? Like, for example, in dermatology, is there sampling strategy used by the company or something like that, or is it only productivity?
No, there's nothing else which you could see. In fact, the FRS is well in control. The debtors days have been around 25 days. So the two things which we need to worry about is the FRS and the debtor days on the quality side. So both of them are okay. But this business has been on around 700 people last year. So the productivity in one of the business is very, very low, which houses 300 people, which is gynae plus plus. So that is the point, that is the soaring point. If you take that out and only focus on more derma product, the productivity is quite high. So the EBITDA margins would also be better there. So there's only one piece which is putting it down.
Yeah, so actually, good point. That was my second question is, like when you took Strides portfolio, you pruned down the portfolio significantly. As I see this split of this portfolio, derma is big. Even, women's health is not a very big portfolio. It's small at about 20 crore. No big brand exists in the rest of the portfolio. Do you think it's worthwhile to even consider the rest of the portfolio?
So, Anubhav, one good news is that last year we give a breakup of, CNS and nutraceuticals this way. But internally, the way we are shaped up, the gynecology business did around 77 crores last year, the division. And we are in line to do 115 crores this year. And the major impact there had been a product called Relude, which we are looking at around 35 crores in this year. So there has been, and we had a very good campaign in the last couple of months. So it just comes at the right time. We are having certain possibilities in our portfolio. And we were looking at, how do we take it forward? Because we have decided that this would be our, after metabolic, this will be the biggest franchise over the next 3 to 5 years. So, it just sets in there well.
Sorry, I did not. Which product you're saying is so good in Oaknet portfolio, which will fit very well, which is a gap in your portfolio right now?
No. So what I was saying is, look, Oaknet is now 100% subsidy. And if you read the slide, we say that there is a cross-selling opportunity. So internally in Eris this year, we have seen a very big jump in the gynecology business. We did 77 crore last year, and we have taken a 115 crore target for this year, which has actually happened because of launch of a dydrogestrone in Eris.
Okay.
So we were trying to increase people in Eris in the next year any which ways, because the productivity does allow elbow room to add people. So this division and our brands, we will have a lot of cross-play there.
So understood. So you're saying that you can improve productivity because you anyways needed people, but okay. So this is true about gynae. What about the other anti-infective portfolio of the company, or let's say gastro products, etc.? Are those meaningful areas you will continue, or you may not continue?
We are not disrupting it, Anubhav, the way we disrupted the whole Strides thing now. Because while we were taking Strides, we were very clear that what we want to get out of that is around 35-40% EBITDA over a couple of years. Here we are focusing on the overall expansion of revenues. So we are not disturbing the apple cart, if you can call it an apple cart. So we are not, talking about tail brands being pruned off. They have their own life. Over a period of time, tail brands do have problems. But we are not pruning them off. We are only adding. So that is the reason we are not saying that we will pull off anything. The rest brands will remain there. We are not, reducing the numbers. So there is no disruption in the entire thing.
And I'd just like to weigh in here. The company on its own has been doing a lot of pruning over the last couple of years because they had a very small franchise in cardiology, cardiometabolic, and some other brands. So there is a lot of rationalization that they have done on their own, and so the focus will be on expansion and growth.
Just one clarity. Out of 650 reps, almost 350 are for derma. Right now, 300 is for rest of the portfolio. So then the productivity is not too different across the two portfolio, right? Yes, derma is like almost 60% of the revenues here, but not too different, right?
No, derma, what derma houses is around 122 crores, if I'm not wrong.
Yeah, but supported by 350 reps, right?
Yeah. And what the other division houses around 68 crores.
Yeah, so the derma productivity is like 3 lakhs and the other division has a productivity of 1.5 lakhs.
Correct.
Okay. And just for clarity on the prescriptions, let's say if we concentrate only on derma portfolio 122 crore there, roughly what percentage of prescriptions are coming from the specialist dermatologists versus GPs here?
So that's the breakup which we gave.
Yeah, so 43% of the prescriptions are coming from dermatologists, that is specialists. Whereas for the market, 38% of the prescriptions come from dermatologists. So Oaknet has a better skew in favor of specialists compared to the average derma market.
And in terms of state-wise presence, is it a national player or like skewed sales coming from certain states?
So like every businesses, there are skews and there are certain markets which are not doing well. So give us some time to get on greater details. But the first look says that East and North are better and West and North are, West and South are not there in the productivity as of now.
I just have one clarity on the guidance given for ex-Oaknet, basically the base business of Eris. So effectively 15% guidance means we are talking about adding close to about 200 crore incremental revenues. Out of this 200 crore revenues, can you just talk about the products that you have not launched so far? What kind of contribution you are assuming from them in this guidance? Let's say 50 crore kind of number, 70, what's the sense?
Anubhav, that would be quite detailed. I don't think we'll be able to do that on a call. But largely we say 5 to 6 very significant products. One of them we just launched right now, which is called Zomelisti, which is DAPA and Vildagliptin. But the total, I can tell you from a 200 crore, the new product will be very sizable. But clearly, to put it that way, we have not done that math.
So just to get the idea of these 5-6 launches, I think that will be largely public knowledge. So let's say Sitagliptin, I'm assuming Valsartan, Sacubitril, and Zomelis, which will launch. So this 3 will be out of those 5-6?
So yes, Zomelis D would be there, Sita would be there, a combination of Sita would also be there, and there will be more. There are a lot of more. What I can tell you, look, the future is Sita, a DPP4 and an SGLT2 combination. So that will happen in 3 to 4 avatars, right? Plus there will be some more products with dapagliflozin. So if you look, everything we say 15, but 6 of them are very significant. When I say very significant, Anubhav, we have talked about this. We think 3 years 50 crores and 6 years 100 crores. That is where we said significant, very significant.
Okay, thank you. Very useful.
Thank you.
Thank you. We'll take a next question from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So just on this Oaknet, in terms of the revenue growth for next 2 years, leaving aside the cross-selling and on the existing product, like for example, in case of diabetes, there's a good clarity in terms of the new molecule itself coming to the market. So that way, is there any growth potential on the derma side, or rather, which kind of new molecules you intend to add in the derma space?
So look, we can do a lot, but how much we do, we'll have to wait a while. If you ask me the possibilities is new age derma, the possibility is total cosmetology. Because as I said, the bedrock is the dermatology prescription, even for cosmetology business. So from the probability point of view, there is an entire new age dermatology, the antifungals with combinations, and there is cosmetology. But we will have to see how much we can chew. So that is something which we will figure out over a period of time. So we'll need at least 1 quarter more to get little more detailed on this.
Okay. And just on the guidance with respect to the organic growth of 15% in top line as well as 15% in EBITDA, effectively it implies 36% EBITDA margin for FY23 on organic basis, wherein for the fourth quarter we are at 32%, and the opening remarks had comment on in terms of higher spend on the promotional front, given the pace of new launches going to happen for FY23. So still you think you will be able to maintain 36% EBITDA margin for FY23?
Yeah, we think that's the reason we have put it there. The reason is very simple. The new brands which were launched in the last 2 years are now scaling up. So that scale is very useful, as KK pointed out, that we are looking at Zomelis franchise as 100 crore this year. So this could have been the shortest 100 crore for us. And we know that, at this price point, it's quite profitable. So this is what will work to the advantage, which will nullify, all that growth spend which would happen.
All right. Thanks. That helps.
Thank you. Our next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi, good evening. My question is actually similar to the earlier participant. So my exit rate of Q4 is about 32% on Concall and 36% on standalone. And there is a ramp up of product launches, insulins, which are relatively lower margin product, plus the 15 plus launches that you're talking about. I understand you spoke about these recently which are scaling up. But given the cost escalation across segments, achieving 36% margin on base business, how confident you are? And apart from the new launches, what would be the other building blocks to that?
So Prakash, KK here. One thing I would like to clarify is that starting Q1 of next year, we actually plan to start reporting segment-wise EBITDA. So that will give everybody complete clarity in terms of how each individual business is performing. So having said that, the interplay of various factors, and this was an expectation that even we had going into the year, that this is the year of such heavy investments. So can we maintain the margin? But we ran the math, and whatever the math tells us is that we will be able to do this. So if you look at our standalone business this year, we had a 40% EBITDA margin. There is nothing on the face of it which tells me that we will not be able to maintain that EBITDA. And the other aspect, which is basically the loss that will be brought in by insulin, right? Because this is like the first full financial year. We have considered those aspects, and taking all of those into account, it is looking clear that we should be able to hang on to a 36% EBITDA margin on a whole year basis. Now, what I have still not worked out is how will this vary on a quarter-on-quarter basis, because certain things happen in certain quarters. Like, for example, we have said that we are adding 170 field force in the Eris cardiometabolic divisions. Now, all of that is happening in quarter one. Similarly, we have spoken about new product launches, and we even discussed some names. So some will happen in quarter two, some will happen in quarter three. So what I can't clarify now is how the quarter-on-quarter EBITDA profile will vary. But on a full year basis, we should be able to be very guided.
That is consol 36%, base business.
Consolidated 36%. Yes.
Yeah, that will be commendable. I mean, given the so many things going on in the company.
Yeah, but Prakash, if you just look little closer, you've seen that our gross margin has actually improved in this year.
Yeah. Standalone has gone from 82.5% to 84% this year. We have had around a 150 bips improvement in gross margins.
So it's all basically comes down to the product mix. If you have solid brands which keep on growing, and let me tell you, there is no better delta than productivity gain for improving EBITDA. So if we are gaining productivity, then it works out very well.
Understand. And there's also comment on the ESOP plan. So how big it is and what is the yearly P&L impact on that?
So we have this round of ESOPs that has been issued, the dilution is around 16 basis points, and the P&L impact of that will be in the range of 3.5 to 4 crores. That has also been factored into whatever numbers we are talking about.
Okay, understood. And from the tax side, we would be starting to inch up from now only, or it would be the fiscal 25 where you will enter the 20% tax rate?
Yeah, so we ran the math here. It will be a step jump in FY25, and let me walk you through that. So in FY25, we will have both the Guwahati and Gujarat manufacturing facilities operational. And based on the math that we ran, we see a blended effective tax rate of 28 to 29% in FY25. As production from the Gujarat facility will still be ramping up, but this will come down to an 18 to 19% level by FY30 as production from our Gujarat facility ramps up even further. So just to recap, 28-29% in FY25, going down to 18-19% by FY30. Having said that, we will be able to avail of our accumulated MAT credit till the end of financial year 29. So even though the book tax rate will increase in FY25, this will not impact our cash flows for the next 4 or 5 years after that.
Okay. Fair enough. And lastly, so we had about 500 plus crore cash and we used 300 and 350 we are taking as a debt. So what's the plan here? Are we keeping some for future acquisition? Is the plate too full? What is the plans on the M&A side for fiscal 23?
So there are a lot of opportunities on the table at any point in time, Prakash, and you're absolutely right. It did not make sense to completely clean up the kitty. That is one. Second is on a monthly basis we expect to throw up 30-35 crores of cash as we speak. So it is clear that we don't want to be reckless. I think we've discussed this before. We don't want to make acquisition just because there is cash. We have taken our time to screen opportunities, and all the criteria that I had outlined to you in the past, like we will only look at a specialty company, we will only look at high gross margins. So we have put things through many of those screens, and only those kind of opportunities will go through. And this is a very exciting time for expansion, and we are going to be very, very focused on expansion over the next 2-3 years, whether it is organic or inorganic. So you may consider this as some kind of war chest for the same.
Okay, thank you and all the best.
Thank you.
Thank you. Before we take our next question, we would like to remind participants to ask a question. You may enter star and 1. The next question is from the line of Tarang from Old Bridge Capital. Please go ahead.
I just wanted to check what's the cost of debt and how much of it is fixed, how much of it is variable?
Yeah, this will be answered by Sachin, our CFO.
Hi, Tarang. So we're taking debt at 6.75%. It's variable, but my sense is it should be fixed for 1 year at least.
Thank you. Okay.
Tarang, do you have any more questions?
No, that's it. Thank you.
Thank you. Any participant who wishes to ask a question may enter star and 1. We'll take a next question from the line of Gagan Tareja from ASK Investment Managers. Please go ahead.
Yeah, good evening. Am I audible?
Could you speak up a bit, please?
Yeah, is this better?
Lot.
Yeah, so just a couple of questions. One, what are the contours of your arrangement with MJ Bio for the insulin deal? You'll be procuring your insulin from them. And second, again, from a regulatory standpoint, what are the approvals that MJ Pharma has for its insulin products?
So I'll answer the second question first. Starting 2016, MJ has been supplying human insulin vials and cartridges to nearly 25 countries around the world. So they have approvals for India, clearly, and they have approvals for a bunch of semi-regulated markets.
South Africa is what they got just last month.
Okay. So South African TGA is also approved then. But our interest and our alignment with MJ is clearly for the Indian market, where the value proposition is that MJ will be doing the manufacturing and we will be doing the marketing. And insofar as the new product pipeline is concerned, including products like Glargine and Liraglutide, MJ will be responsible for clinical development and regulatory approval and commercialization. So that's the overall contours of the deal.
Right. Would it be fair to assume that gross margins here would be significantly different from your base portfolio?
Yes. See, human insulin has been under price control for a long period of time. So human insulin is not a very exciting product in terms of gross margin. But then human insulin is not the reason why we even got into this. The reason why we got into this whole venture is for the insulin analogs like Glargine, Aspart and Lispro, and for the GLP-1 agonist products like Liraglutide. So once those products come into play, and our expectation is Glargine we are pegging in calendar year 23 and Liraglutide in calendar year 24. So once those products come into the mix, the gross margin profile of that business will change dramatically. So that is our overall thesis on which we've gotten into this business.
But KK, if after the 10% price hike, the margins will be as good as the Oaknet margins. Yes, they will be.
Okay.
Okay. And does MJ Biopharma have a WHO GMP for their facilities?
That is right. They do.
Okay. Sir, one final question. While you indicate that the diabetes portfolio, will see a jump in DPP-4s and SGLT2 combinations, which will enable you to prop up your growth there. It will come at the expense of sulfonylureas, which today are the mainstay for your business. To a certain extent, there will be cannibalization between the two. If you could help us understand, how should we think of your sulfonylurea portfolio, and at the same time, the transition to DPP-4 and SGLT2 could create what scale for you in that segment?
I'll just provide some numbers and then defer to Amit, who can provide you with a lot more insights. See, sulfonylurea market is not going to get replaced. This is basically about diabetes is a progressive disease, right? So in the initial years, the patient might be on one therapy. And then, as the disease progresses, you progress to what is called polytherapy. So you start with one product, then you go to 2 products, then you go to 3 products. So we don't see a scenario where glimepiride is going to vanish from the prescription. And what does that mean in terms of numbers is that the volume growth and the value growth of glimepiride segment will slow down. So we are pegging glimepiride at a 2 to 4% volume growth, and then you slap on some price increase. It is possible to get 6 to 8% per annum growth in glimepiride, which is what we are looking at. Whereas DPP-4 and SGLT2 is crazy because in the first year, the market gets created. I mean, Vildagliptin is seeing 50% year-on-year growth even after 2 years, right? So what happens is both segments grow, but glimepiride grows at a slower rate. So if you look at the mix of therapy, that shifts to DPP-4 and SGLT2 over time. Those therapies become more heavy, but that is not because sulfonylureas are degrowing. Amit, would you like to add anything?
Yeah, so technically, it's all about the first line treatment. So glimepiride metformin has been a first line treatment for a long period of time. The first line treatment now is moving to DPP4 and SGLT2. So we will have less initiations of new patient on glimepirides. But when diabetes becomes brittle, it becomes 10 years old, then typically you need a sulfonylurea to get control. So as KK has aptly put, we are ourselves budgeting a volume growth of 2 to 4%, plus some price bolt on here and there. 6 to 8% is what 8% is what we are kind of budgeting.
And with NJ Pharma, Biopharma, is it a contract manufacturing fees plus royalty arrangement, or is there a profit share arrangement with them?
See, the profit share is automatically built in, right? Because MJ is an equity partner in this business. So MJ Biopharma holds 30% equity share in the venture. Long-term strategic arrangement.
Okay. Thanks. That's all from me.
Thank you.
Thank you. Our next question is from the line of Sonal Gupta from LN Mutual Fund. Please go ahead.
Yeah, hi. Just one question. I mean, could you guide for the effective tax rate you're looking at for FY23 and 24?
Are you talking about effective tax rate for 23-24?
Yes.
We don't expect it to be significantly different from what it is now, because the Gujarat facility will come on stream. So maybe it might go to 11-12%, but we don't expect a massive jump over where it is right now.
Okay. So just to be clear, so the Guwahati facility goes, I mean, like, will not have any tax benefits from FY25, and that's why we're going to see the jump in 25, right?
That is right.
And what's the benefit at Gujarat? What sort of tax benefit do you enjoy?
So this is basically, there is no special tax benefit available for Gujarat as a location, but under the whole Make in India regime, we will have a effective tax rate of 15% plus surcharge in the Gujarat facility. So this is nothing special about Gujarat. This is available, wherever you would set up this facility.
Okay, so this is a new manufacturing facility subsidiary. Yes, sorry. Yeah, thanks a lot.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference back to Mr. V. Krishnakumar for closing comments.
Thank you. Thank you everybody for your participation in the call. By way of summary, Eris has entered the dermatology therapy through the acquisition of a 100% stake in Oaknet Healthcare at an equity valuation of rupees 650 crores. Eris's specialty franchise will get a significant boost with the acquisition of Oaknet. The acquisition brings marquee brands like Cosvate and Cosmelite into the portfolio. We expect the Oaknet business to deliver a revenue of rupees 250 crores with an EBITDA of rupees 50 crores in the next 2 years, that is in financial year 23-24. We delivered an EPS growth of 14% in the financial year 22 on the back of a 21% EPS growth delivered in the last financial year. This represents a compounded average growth rate of 18% per annum over the last 2 years. FY23 is a year of significant investments in terms of the insulin business, field force expansion, landmark new product launches, commissioning of a new manufacturing facility, and SAP implementation. We expect our organic growth to be driven by growth in our power brands portfolio, new product pipeline, expansion of specialist and CP coverage, and our expansion into newer specialties. For the year financial 23, we are targeting an organic revenue growth of 15% and a combined revenue growth of 30%, including Oaknet. We are looking at an organic EBITDA growth excluding Oaknet of 15% and an organic EPS growth excluding Oaknet of 11 to 12% in FY23. Thank you all. Have a good day and stay safe.
Thank you, members of the management. Ladies and gentlemen, on behalf of Eris Lifesciences, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.